Hello there. Wanted to do a little video for you today about short selling, shorting stocks. Something what comes up a few times and a few questions over the last few weeks about this. And I'm guilty of assuming that everybody already knows about shorting or short selling, and consequently I don't think I've ever explained it in my videos. You might have seen in my live trading videos I'll short quite often, if you know what I'm talking about. So, shorting, profiting from falling markets. Let's have a look at this in a little bit more detail and explain what it is and how it works. So, what is shorting? Well, before we explain what going short is, we really need to just make sure we understand what going long is. Going short is the opposite. So, when we talk about going long, we've got an objective essentially of trying to profit from rising prices. So, if we look at this example chart of Apple here, we might want to buy here, for example, which is around 251.50. If we'd bought 100 shares of Apple at that price, that would cost us $25,150, although in actual fact it wouldn't cost us that much because we trade on margin, but that's a subject for another video. So for the purposes of this video, let's just say that we've just spent $25,150 on 100 shares. We're hoping that the price will go up, and indeed the price does go up, and we sell miraculously at the top of the market. Obviously that never happens in real life, but again, for the purposes of demonstration, let's say we sold around here at 254. For 100 shares sold, that would bring us in 25,400. Therefore the difference would be the profit, so we would have made a profit of $250 between the price what we sold for and the price that we originally bought for. So that's bog standard, going long, buying low, selling high. That's all that's all about. When it comes to going short then, what we're trying to do is the opposite. We're trying to profit from a falling market. So if we look after that high point around 254 to 254.50 at the top there, the price of Apple then dropped away again in the afternoon. If we could somehow profit from that, we'd get two bites of the cherry, as it were, and we can profit from that. So let's assume, for example, that we sold at this point here, which is about 253.50. So we sell 100 shares. We are credited the profit, or the revenue from that sale is $25,350, and that goes into our trading account. Now we're hoping that the price will go down, which it does, and we'll assume we buy back down here at about 252. We buy back 100 shares for a total cost of $25,200. So we sold, we were credited 25,350. We buy back, we pay 25,200, and that means that we've got $150 difference what stays in the trading account, and that's our profit. Sounds simple, but the obvious question is, how do we sell before we buy? Quite easy to understand, obviously, that you can buy stock and then sell it back again. How do you sell before you've bought? That's where the magic of shorting comes in. So let's have a look at the mechanics of what's going on in the background. So first off, we place our order to sell. The broker, who's got our account, looks in our account and sees that we don't have any stock to sell, and therefore we're trying to sell short. So the broker lends us some stock. They take some of their stock, lend it to us, and then sell it on our behalf. The stock is now sold, and the cash proceeds from that sale get credited into our account. So we've now got a load of cash in our account, but we also owe the broker a load of stock because they've lent it to us. So we're now short, we've gone short. We at some point need to cover our position so that we can give the stock back to the broker, which means we need to buy that stock back, and really what we want to do is buy it back at a lower price than what we sold it for. So when we come to cover our short position, we place our order to buy the stock, and we pay for that stock with the funds what we've got in our account. Now hopefully the price has gone lower, so we're paying less money out than we were credited when we sold the stock. So the stock is purchased, and the broker says, thank you very much, I lent you that, so I'm taking that back again now. and so that goes into the broker's account. And the net result of all of that is that the broker has now got his stock back, and because we paid less than what we sold it for originally, we've got a little bit of profit that's left sitting in our account. It might sound quite complicated, but in actual fact, when you're trading, this all goes on in the background and it all happens quite transparently. In real life, you hit the sell button, everything goes on automatically in the background, and you're short. That's all you need to know, really. This is, as I say, doing it with stocks. If you're trading CFDs or spread bet or anything like that, there isn't any of this lending going on because you're not actually dealing in real stock. You're dealing in derivatives, so there isn't anything to lend out. But that's not really for this video. We're talking about stock, and that's how it works. Broker lends you the stock, and then you give it back once you've covered your position. And as I say, it all happens in the background. Nothing to worry about. It's all automatic. So as you can see, the advantages of being able to go short means that you can profit from falling markets as well as rising ones, which means you've got twice as many opportunities to make some money. And also you can hedge your positions, which means you can be short in some stock and long in different stocks, and that protects you if there are major events in the market that move it violently in one direction or another. So if the market suddenly shoots up and you're short, then your long positions will hedge that for you and cover those losses. And likewise, if the market suddenly drops, then any long positions will be hedged by short positions that you hold. As day traders, that's not so much of an issue because we're in the market for much shorter periods of the time. It's more of a benefit to swing traders, long-term traders, but it's worth bearing in mind. It ain't all sunshine and light though. There are a few limitations of going short. First off, not all stocks can be sold short. Obviously, the broker's got to lend you the stock for you to be able to sell it short. So the broker's got to have that stock available to lend, and they don't carry all the stocks because there are thousands and thousands of them, and brokers simply can't carry thousands of stocks just in case their clients want to go short. So not all stocks are available to be lent, and of those that are available, they may sell out. So if everybody's looking at a particular stock and thinking, well, that's set to drop, everyone's trying to short it at the same time, eventually the broker will have lent all of their stock out to their customers and there won't be any left to lend. So these limitations mean that sometimes you'll want to go short and you just won't be able to because there ain't any stock available. Now, brokers do carry lists of what stocks they carry that you can go short on and how much of it they've got. Personally, I don't bother looking at them because if I went to look at a list every time I was going to make a trade, I probably would have missed the entry by the time I've looked it up on the list. In reality, you hit the sell button to try and go short. If they haven't got it for whatever reason, then the trade just won't happen, and that's the quickest way to find out. One other limitation is when you're short in a stock, then the broker can charge you interest because they've lent you that stock. It's a loan in stock, not in cash, but it's a loan nonetheless, and so they'll want to take a little bit of cream off on that, so they'll charge you interest, but that's only going to happen if you hold your position overnight. And again, as day traders, we look to be out of the market and not have any positions open overnight, so the interest issue isn't really an issue for us. One other big problem or risk with going short, and a problem as such, but it is a risk that's well worth bearing in mind, is that there is unlimited potential for losses when you go short. Why unlimited? Well, if you think about it, when you buy stock, the maximum risk, the maximum amount you can lose is if the price of that stock drops down to zero. So you've lost everything what you paid for the stock. And if you're trading on margin, then potentially you've lost 4 times what you paid for the stock. But there is a maximum amount that you can lose when you buy stock to sell later on. Now, if you're going short, the maximum risk is effectively unlimited because the price can go up forever, which means that you could end up paying thousands, millions of dollars to cover your position. Now, I've put unlimited in quotes there because in reality, if your losses start mounting up too much, then the broker's going to look and say, hang on a minute, can't let this carry on. If this keeps going on the way it is, this client ain't ever going to be able to buy back the stock with the money what he's got available, and therefore they'll liquidate your position before you do. They'll buy it back with whatever funds you've got. So unlimited potential for loss, although in reality it will never get that far. So to summarise then, going short is an essential tool for traders because it opens up twice the trading opportunities of just being able to go long. You can make money in markets what are falling as well as markets what are going up. And really the only thing to do is just be mindful of the risk. As always in trading, you've always got to bear risk in mind. Just be aware that there's a little bit more potential risk in going short than there is in going long. Okay, hope that clears that one up, and any more questions obviously drop us an email, always happy to help, and have another video for you again very soon.